Hello, investors. Let me try that again. I think I hit the mute button. Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, October 23rd, 4:53 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Right out of the gate, I want to thank everybody for uh, heeding my pleas to click the like button on the videos. I assume if you're watching it, you should like it. If you're liking it, click the like button. It certainly helps us out. We went from like 1 in 10 likes to 1 in 4 of listeners or viewers clicking the like button. Big improvement. So we thank you for that very much. That helps the algorithms get this into other people's feeds, helps us get more discovered, and spreads the word that you don't have to be a slave to the ups and downs of the market. There are common sense rules you can use to guide your decisions along the way. So definitely want to thank you for that. And if you're hitting unlike, tell me what you don't like about it. It's all I'm asking. I'm not expecting everybody to agree with everything that we're saying, but if it gets to if it makes you click unlike, there must be something pretty big about what we're saying that you disagree with. So let's debate that. All right, moving on. So state of the market, we're in a moderate correction. We define that as being more than 8% off of the reasonable highs. These are our various market conditions and what our portfolio expectations should be. So over 8% now. Going from mild into moderate, our expectation is that if we continue lower, closer to 12%, we'll have minor outperformance versus the S&P, and that's simply because we'll have a lower beta. Normally in this area, the market is flirting with or under the 200-day moving average. That's exactly where we are right now. So that's how we classify the action and set the expectation for what we should be. Doesn't mean every day we'll have minor outperformance. In fact, we had minor underperformance today because a couple of the remaining positions that we had were down on the day. We'll get into that when we attack the charts. So you can see over here on the trend gauge, we are in bearish / downtrend for market leadership. And then as far as the 5 major indexes go, also bearish, meaning we're trending, all 5 of the major indexes are trending below their short-term 21-day moving average, their medium-term 50-day moving average, and it's a mixed bag relative to the 200-day moving average. We use these values to dictate our exposure to the overall market. Long term, we've got small caps, mid caps in the Dow below the 200-day, S&P now 2 consecutive closes below the 200-day, NASDAQ 100 still firmly above the 200-day. So what happened today? Indecision, kind of a tease on the S&P. Over the weekend, I read so much on Twitter about a crash today. We ended up gapping down 0.35% on the S&P, and we sold off hard for about the first 15 minutes, getting us under the 4,200 level. But then we had a pretty strong rebound for over 3 hours that carried us back above the 200-day moving average, where we promptly failed and closed back below that level. So undercut and reclaim of 4,200 after the gap down. But above and fail versus the 200-day moving average on the rally, and sold off the last 3 hours. So it was made 2 real major trends during the day, over 3 hours up, 3 hours down. The only bright spot, a lot of bounces in some broken leaders that have broken the 21. Some of them bounced at the 50-day. Some broken leaders bouncing at their 200-day. And the big 7 strong on the day, however. So that held up the NASDAQ, and also very clearly the big 7 results you can see here, up 1.17% on the day. Rest of the numbers, our 8 growth ETF composite, the RG8, down 0.46% on the day. Not too bad. But all 8 of the components are below their declining 21, and their stochastic is negative also. S&P 500 gap down 0.35, got as much as about 0.5% up on the day. Faded the last 3 hours, closing down 0.17%. NASDAQ 100 led up 0.3%. Dow down 0.6. Mid caps down 0.94. Russell 2000 small caps down 9/10. Global 60/40 barely positive on the day. This was led by bonds, which had a price bounce, meaning a bit of a yield pullback. In-house GROTECTION down 0.19% on the day. We'll hit the tail of the tape and charts of interest. Let's get right into it, and we'll start with the S&P 500. Let me bring up a 5-minute chart to detail. So here's your gap down. Let me get my drawing tool on. So here's the gap down in a pretty harsh sell-off, down to the 41.89, and then a snap back, like the rubber band just got stretched too far to the downside after 3 days down and then an additional gap. So we rallied up, didn't exceed the highs of the Friday afternoon, and then promptly sold off over the last 3 hours over the day. So on the daily chart, this makes it an undercut and reclaim of the 4,200 level. That was support going back to the breakout in late May, early June. Was also a resistance level, this 41.95-ish back there, that stopped the January rally in its tracks before we sold off. So this breakout obviously failed. It failed back here before we bounced off the 200-day moving average in late September, early October. Subsequent rally failed into the declining 50-day moving average, and rolling back over now, 4 down days, technically 5 if you count this, the failed breakout day. And that, again, from failed moves come fast moves. Let's look at a 30-minute chart on here. Here's the 43.85 breakout, couldn't even hold for an hour before selling off. Now just stretched a bit too far to the downside. We bounce higher. You can see this kind of resistance area here that we paused on Friday during the rally and paused again today. So that 42.50, 42.60-ish will be a reference level if that the bulls will be looking to get back above. And then failed at the 200-day moving average, which is around this level here, closing back down at the 42 at 42.17 on the day. So what are we looking for now? Obviously, with the gap down and uh, today's lows become an inflection point. As anytime you shake out below a level and reclaim it, you want to reference that. And it really makes the highs of the day kind of critical too. Anytime you reclaim a level and then fail, you want to try to get back above that too. So that makes both today's highs and lows pretty critical. We're still oversold. In fact, let's go to the 60-minute chart and turn stochastics on. And we don't often spend, I say don't often, but once you spend usually 3 days under the 60-minute stochastic, you get some kind of a relief rally up. Here's the 3 days. Today, the fourth day, we got back above it, but then failed. So still considered, I considered oversold, at least on the 60-minute chart. Here's another 3-day period where we got back above it. Here's a 3-day period where we got back above it. Here's a 2-day period. So this tells me pretty weak market there. But again, after 4 straight down days, today's anemic bounce, not good, but we'll track the highs and the lows versus today going forward to see if the bulls can take at least a short-term charge or if the bears are even more firmly in control. Here's the NASDAQ 100. Didn't undercut these levels, or did it actually? I think it did undercut. Today's low 351.12. So yeah, it did undercut the lows from late September, early October. So bounce. So another undercut and reclaim. No key moving averages around this area here. So we're referencing that 350 level for support. First, let's go back to the S&P very quickly. We always want to monitor what happens at this our very short-term moving average. That's the declining purple line. That's the ADMA, as this often contains both pullbacks and rallies for sometimes weeks at a time. So we certainly want to reference, if we get back above today's highs, what happens when we hit the declining 8-day moving average. That's another signpost that I'll be keeping an eye on. Let's go to the Dow, which had been showing relative strength. Not quite today. You can see the little bit of a hook down and today's low 32,892 didn't undercut, so still holding the lows of late September, early October. On to mid caps. Look at the mid cap MDY ETF making lower lows on this pullback and closing near the lows of the day. No rally whatsoever. IWM small caps just barely off of the lows of the day and below these lows, going all the way back to March and then even further back into 2022. Just an absolute mess on small caps. Let's go to the VIX. Uh, Bifurcation on the VIX today. Big move up, obviously, when we were selling off, and then came down and actually closed lower on the day, undercut the 20 area, but then bounced off the 20 area. So this is still really not a benefit to bulls. Tough times going on here. Let's go to the dollar UUP. Hey, every day we survive, we get closer to the next rally. We know William O'Neill's system is time tested. Following the approach gets you in, identifies and gets you in the next big winners. As long as the capitalism is alive and well, uh, the U.S. markets are the place to go. But there are a lot of crosswinds and headwinds, so we are constantly fighting those. UUP, the dollar, broke below the 21 day. That's a good sign. We could use that. Weaker dollar is normally good for markets, not necessarily today. So some of these contrary indicators that we saw before are not necessarily helping things out. And at least for today, that included the precious metals. Gold stocks, really a nice run, so it's a normal pullback. This Friday action poked above the 2000 level and is pausing right there. This is kind of a normal spot to pause and pull back at least to the 80 MA. That's GLD. We own that. GDX is gold stocks. Not as nice a chart, but then again, these are stocks and the stock market not doing so well, although certainly showing some relative strength. And silver, not as strong as gold, still below the 200-day moving average. Now let's go to bonds. Let's go to the 5-minute chart so we can see we started the day lower in bonds, meaning prices higher, and then started to rallied up along with the market, and then didn't fade as much as the market faded. So just kind of going sideways. Let's go to a daily chart. This is the broad bond index. So basically, we've got kind of a floor here, the lows of today and last Thursday to keep an eye on. TLT. Kind of the same situation, ran into the declining 80 MA. Let's go to the yields. If the prices are up, the yields are down. Harsh uh, pullback here in yields right to the 80 MA TNX, the 10-year, pausing at that 5 level. That's 5% on the 10-year, sitting at the 80 MA. I'll go to TBT real quick. We trimmed some of our TBT today, also bounced off the 80 MA on the outside negative reversal. Now, something acting well, Bitcoin, a gap up, close at the highs of the day, a headline hit in the afternoon, and all the Bitcoin stocks all rallied today also. Uh, a decision on the spot Bitcoin ETF. The courts sent it back to the SEC for them to take some action as the SEC missed their deadline. They didn't reply to the court's decision to vacate the uh, Grayscale's lawsuit against the SEC to approve their GBTC, converting it to an ETF. The SEC didn't challenge it, so the court said, "Well, let's make a ruling then on what GBTC." And that the theory is that's going to open the door for a bunch of spot Bitcoin ETFs. We are taking a look at BITO for an entry. Also, Coinbase helped out by this today, but closed off the lows. Certainly one of the better looking charts, at least from a consolidation standpoint. Looks same thing on the weekly chart. You can see it trying to put in a multi-week bottom here. Now we need to see some relative strength. You see the market going down, but this not going down on a relative basis. This is one of the hallmarks that we look for when the market rights itself. We're always looking to identify relative strength. So that's our inter-asset correlation. Let's go to the tail of the tape. We can pause this. You can pause this to read through it. I'll hit the highlights. VIX still inverted just barely though. So a little bit of improvement there. Day count, fourth day down, fourth day below the 80 EMA, fourth day below the 21 EMA. Big movement coming up this week. The reaction to earnings after hours tomorrow, Google and Microsoft. Wednesday, Meta. Thursday after hours, Amazon. Bitcoin and the Bitcoin complex, XLC, K, and Y. Those are the tech indexes, the tech spiders. Positive today. Builders positive with the pullback in interest rates. Basically every other sector in the S&P negative, retail negative, biotech negative, oils too. In-house, we trim that TBT. We also trim more SSO as we failed at the 200-day moving average, and we sold our NRGU. Oil stocks had a weak day today, perhaps triggered by Chevron. Exxon made an acquisition last week. It was Chevron's turn over the weekend buying Hess. That might have put some strain on oil stocks, but really ultimately we'll go to the chart to decide. And NRGU failing below the 8 to 21 and the 50-day moving average. I mean, if oil's, this could be a normal pullback, but we took some profits up here and got out for a small profit here. Don't want to have a significant green move turn red on us. So wrapped up that trade for a small gain. Same thing with TBT. And SSO, we're pulling back to near the areas where we started to get into SSO at the beginning of this rally. So booking a small gain there, taking it down from over the last 2 days from a 30% position, meaning 60% passive exposure to the S&P, down to 20% or 40% exposure to the S&P, and that dropped our beta to 0.40. Bottom line on the day, S&P 500 teased both the bulls and the bears, showing indecision with the 4,200 above and reclaim. That was the good news. The bad news, failure getting back above and then failing at the 200-day moving average. Big seven led. Are they just bounces? Oversold bounces could be, but as always, we'll keep our finger on the pulse of everything. Let's take a look at a couple of charts very quickly. I showed coin. DraftKings had a good day today. A lot of these stocks have fallen off our 21 list. Some of them go on the below the 21, but they're holding the 50-day list. DraftKings even below the 50-day, but it had a nice day today. I believe it got an upgrade and up 4% on the day. They report earnings in 2 weeks. NBO, we stopped out of this last week, a little bit of a bounce here. And holding the 21. So you see, look at this wedge here, really tight declining trend lines along the declining 80 EMA. On the bottom is the 21 EMA. Lilly, LLY, the other weight loss drug, breaking the 21-day moving average today. Let's see, Lulu, I believe is showing some relative strength here. Yep, holding the 21 on the pullback back above the 400 level. That's going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, contact my partner, Dan Stewart, dan@revereasset.com. Remember, it's not how much you make in the markets, it's how much of that you can keep. These are the last 13 bear markets. Some of them just run-of-the-mill 20% losses, some of them much more severe. The average of all the severe bear markets down 44.5%. The important thing is to remember is that all of these take place below the 200-day moving average. That's why we get very defensive when we're below the 200-day moving average. Just because we broke it doesn't mean we necessarily are going to go into a free fall. The market could hold at these levels as there is a decent amount of support at this 4,200 level. That makes today's lows critical to keep an eye on. And with that, I'll wrap up the video for Monday, October 23rd. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.